What's going on, guys? My name is RJ and this is the Gen Z Investor channel where my goal is to change the way investors invest in the stock market. Now in this video, I'm going to teach you how to generate consistent income selling options. Now there's many other YouTubers and many people online who will teach you how to sell option premium, but they do not have very solid strategies and they will end up not maximizing your income or your rate of return of your portfolio in the long run. And there's really a specific strategy that you need to employ in order to consistently make income. So in this video, I'm going to lay out 4 steps that you need to take in order to be a successful trader. So step number 1 is that you need to get over the notion that selling option premium is risky. Now, if you are interested in why I say this, I have a separate video on that, and you can either click the link in the description below or you can click the card at the top of your screen. But the short answer is that there's essentially no circumstance where being long stock is better than being short a put. You're almost always better off selling option premium rather than going long stock, because essentially you're just agreeing to buy it at a cheaper price. Additionally, there is no other strategy out there that is going to consistently make you risk-adjusted returns on the stock market. So whether you are a day trader, forex trader, you trade penny stocks or any of those financial instruments or even futures, or if you are a long-term investor, the odds that you are going to achieve risk-adjusted returns on the stock market are pretty slim. However, when you sell option premium, you actually have the potential to make a risk-adjusted returns if you have the right strategies and you make the right choices. Now, step number 2 is you're going to want to create a watch list of no more than 20 securities that you want to trade and are comfortable owning. That is a very important point, which is why I underlined it. Because when we sell naked put options, which is the strategy that I'm going to get into, we're basically agreeing to buy those shares at a future date. So it is very important that you are comfortable owning those shares and you do not trade stocks just because they have high implied volatility. You really need to actually believe in the companies that you're trading in order to reduce the risk of a large drawdown in your account that will end up blowing up your portfolio. So in terms of the stock watch list criteria, first, you're going to want to understand liquidity. So if you don't know what liquidity is, it's a market's ability to allow assets to be bought and sold easily and quickly. So you want to trade very liquid options, because if you trade options that are not liquid, by buying and selling them, you're going to lose money due to slippage. Additionally, there is a chance that you do not get filled on your orders if you're trading illiquid options, just because there's not enough people trading those products. So it's very important, if you want to maximize your return, to sell options that are liquid. Step number 2 is you want to only trade companies that are high market capitalizations. This kind of goes into the whole liquidity, because high market capitalization companies tend to have more liquid options. So you can kind of kill 2 birds with 1 stone. So if you don't know what market capitalization is, it's essentially just the total dollar market value of the company's outstanding shares. I personally do not sell option premium on companies that have less than a $10 billion market cap. You want to only be involved with companies that have large underlyings and have very stable cash flows in order to reduce the risk of a company going bankrupt. Now, my third point is that you want to choose companies in different sectors. So this allows you for diversification benefits of uncorrelated assets. If you want to learn more about that, you can click the card in the top right-hand side of your screen. That will lead you to a video that I made called Options Portfolio Management. The short answer is that when you trade companies in different sectors, they are uncorrelated, which means that they move in opposite directions of one another, and you can basically reduce the risk of your total portfolio. From here, I would recommend going on to a website called FinViz and going to the maps section of the website. From here, you can get a very good understanding of what stocks that you can trade. So what I would do is I would pick 1 or 2 underlyings or companies from each one of these different sectors. So from technology, in my own personal portfolio, I trade like Facebook and Microsoft. In the financial sector, I trade JP Morgan and mostly PayPal. Sometimes I'll trade Visa. From the services, I mostly only trade McDonald's because it's a low beta stock, which means that if we go into a recession, it likely will not be impacted greatly because people aren't going to stop buying hamburgers. I really don't trade Amazon that much just because I like trading naked options and it's a very expensive stock. For consumer goods, I trade Apple and Coca-Cola mostly. However, you got to be careful with the correlation between like Apple and Facebook or Apple and Microsoft, which I'll get to in a second. For industrial goods, I trade Boeing mostly. Sometimes I'll trade Raytheon. Healthcare, I trade mostly UNH or J&J. Actually, I haven't traded J&J in a while. And for basic materials, I really don't trade basic materials. I don't think that they really offer that much diversification benefits. So instead, I'll put gold in my portfolio because it's not correlated with the stock market that much. So if you want to know more about options portfolio management, I have a separate video if you want to click the top right card. Additionally, I'll have it linked down below in the description. But really, after you've picked the companies that you want to trade, it is really important that you run a regression on the different underlyings to make sure that there's not a high correlation. If there's a high correlation between two stocks, I personally don't like to trade them because I like to have my portfolio as diversified as possible and not get caught up in a lot of concentration risk. So what I do is I go on to a website called portfoliovisualizer.com and I type in all the underlyings that I'm trading. If there is higher than say 0.4 or 0.5 of a correlation between two underlyings, I'm very careful about not trading too large because that can get very messy very quickly. So here's just a sample of what a general option portfolio should look like. So here I've got 5 different underlyings in different industries, which will offer me a lot of diversification benefits. Additionally, I have gold in this example, again, because it's very uncorrelated with the overall stock market. So what this will do is it'll offer diversification benefits because if the stock market moves down, gold will likely not move down with it. Moving on to step number 3 is you're going to want to wait for one of the underlyings on your watch list to correct downward. We do this because as the stock price moves down, the implied volatility of the options increases, which means that we are able to collect more premium and reduce our risk because the stock has already corrected downward. And additionally, you're going to want to sell a naked put option on that underlying with a strike price that's 1 standard deviation below the current market price. Step number 4 is if the option you sold does not get challenged, which means that the underlying does not trade close to your strike price, then wait for the option to decay between 50 and 65% of the credit received and close out that position. That 55 to 65% number is just a general rule that has been shown through back tested from a number of different people that is kind of the optimal time to close out your position because options out of the money decay non-linearly. There's going to be a part of the decay curve where it's the steepest, and that happens usually between 50 and 65% of the credit you received. Next, if the option you sold does get challenged, then roll that position to the next month. What this means is that you'll be closing out that position and opening up a new position with a later expiration. Thus, you'll be able to collect additional premium or theta because as insurance companies, we are paid for our time. So the longer the option has, the higher the price it's going to be, all else equal, because there's more time for that option to potentially be exercised. Additionally, you want to sell options that have about 45 days till expiration. That has been shown to maximize the return of your portfolio for the given level of risk. So after you roll the option, most likely you can simply just wait for the stock to rally and then close out that position for a profit. Again, we are only trading very high market cap companies, so the likelihood that the position, if it does get challenged, will eventually rally will be quite high. Furthermore, one thing that I want to point out is the inverse relationship between price movements and implied volatility. So in this circumstance, here's a screenshot of a 6-month chart of Facebook. And as you'll notice, when prices correct or move downward, the implied volatility goes up, which means you can collect more money. So in this case, if you were watching Facebook and you saw that it went from 208 all the way down to about 180, you would identify that that's a good time to sell a naked put because implied volatility is high. Additionally, the stock has corrected more than 10%, so that's a very high probability trade. And you'd probably sell a put option with a strike price of about 160 or 165. and you'd end up making money on that position after volatility contracted. Again, volatility is mean reverting, so if it is really high, like what we had back in early August, you would sell a put option, and even if you're not right directionally, you have a safety net where the stock can continue to trade downward. Additionally, with implied volatility going down, that means that the price of the option is going to decrease, all else equal, and you'll be able to keep most of the premium that you collected. So in the most ideal situation, you would want to look at a high quality underlying like Facebook, wait for it to correct downward where it has very high implied volatility, and then you're going to want to sell a naked put 1 standard deviation below where the stock is trading at that moment. Another important point is that other option sellers on YouTube will tell you to trade complicated neutral strategies such as iron condors, straddles, and strangles. However, this will not maximize your returns for the given level of risk you're taking. Additionally, you will have to pay more in commissions. So the reason why people will tell you to trade neutral strategies is that markets pretty much follow a random walk. So at any given point, the likelihood of a stock moving up or down is basically a 50-50 bet. However, what they fail to realize is that when implied volatility goes up, that's usually a result of stock moving down. So if you sell a put, you're taking advantage of the high implied volatility. It's a better idea to wait for opportunities or corrections in stocks in order to sell high implied volatility, and you can basically wait for a volatility contraction and you can close out that position for consistent profits. So hopefully you'll realize that simple is beautiful. Selling naked put options into large corrections is the way to make money in the stock market. The more simple you are and mechanical you are in your trades, more than likely you're going to end up being able to maximize your returns. Anybody who tells you otherwise probably doesn't understand the option market and really doesn't have a firm grasp on implied volatility and price movements of stocks. In conclusion, thank you for watching. I hope you can use these tips to go out and make more money on the stock market for yourself. Furthermore, please share this video to anybody who wants an easy way to make consistent profits in the stock market. If this video was useful, please make sure to give it a like. If you have any questions, leave a comment down below. Subscribe to my channel for more content. Again, my name is RJ. This has been the Gen Z Investor channel, and I hope you have a wonderful rest of your day. And peace out.